$2 trillion. Erased. In 3 hours. A world at war. Oil near cycle highs. Equity markets in freefall across Asia and Europe. And gold, the textbook safe haven, crashed nearly $400 in a single session. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold hit $4,099 today. Silver hit $63.15 on COMEX May futures. The war did not save them. The yields did. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Monday, March 23, 2026. London Open. Gold spot XAU USD opened at $44.91. It crashed to a session low of $4,090. That is an $87 gap down from Friday's close, followed by a further $305 extension lower, in under 3 hours. Silver's COMEX May contract hit $63.15, a 9.34% single-session collapse. The Nikkei fell 3.9%. South Korea's Kospi shed 4.5%. The U.S.-Israel military campaign against Iran entered its 4th week. The Strait of Hormuz remained effectively closed to commercial shipping. Every macro model built on war equals gold bid was invalidated in the opening hours of a single session. The timing is what deserves scrutiny, not the war itself. The timing. Think about what that sequence actually means. If gold cannot hold a bid in week 4 of an active U.S. war, what exactly is the market pricing? The ones paying attention already know what to watch next. Before I build the full picture, consider this. The U.S. 10-year Treasury yield is at 4.41% today. That is an 8-month high. It has climbed 44 basis points since the war began. Not despite the war. Because of it. Sit with that. Now let's build the full picture, because this session does not exist in a vacuum. The Federal Reserve held rates at 3.75% at its March meeting. Updated Fed projections, published by the Federal Reserve Board at federalreserve.gov, show one rate cut projected for all of 2026. The 2-year Treasury yield rose nearly 10 basis points to 3.9% today, per U.S. Treasury data at home.treasury.gov. The DXY dollar index, tracked by the ICE Benchmark Administration, sits at approximately 99.65 to 100, having surged more than 5% from its February low of 96. The mechanism is structurally precise. War creates inflation. Through energy prices, supply chain disruption, and defense spending. Inflation forces central banks to hold or raise rates. Higher rates make government bonds more attractive than non-yielding gold. The 10-year yield at 4.41% is not a peripheral factor. It is the dominant price-setting variable in precious metals right now. The rate of yield climb is not slowing. It is compounding. The data is doing the talking. The ones who called this a simple war equals gold bid trade, they are not saying much right now. And here's what makes that picture even harder to ignore. Gold opened with an $87 downside gap from Friday's close. That gap was not random. It is the direct consequence of structural overpositioning during the January to February rally, when managed money built near record long positions based on the geopolitical bid thesis. When that thesis failed at the London Open, the unwind was mechanical and immediate. At the same time, COMEX registered silver stands at 27.1 million troy ounces against 429 million ounces of paper open interest. The April 1st notice day is 7 business days away. That is not a background detail. That is a live structural stress point running simultaneously with the macro sell-off. That is not a contradiction. That is the setup. And before anyone takes today's partial recovery as a green light, setups like this can take a long time to resolve. What today tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the Iran variable, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not framing correctly. 20%, approximately 20% of global oil supply transits the Strait of Hormuz every single day. That strait is currently effectively closed to most commercial shipping. Trump issued a 48-hour ultimatum over the weekend, demanding Iran open the strait or face escalated strikes. Iran responded by threatening to strike Gulf energy and water infrastructure. Trump then announced a 5-day postponement of strikes following what he described as productive diplomatic conversations. 5 days. That is the current window. Markets are pricing a clean resolution within that window. Look at the 10-year yield at 4.41% and the DXY at 100, and tell me what probability you assign to a complete Iran de-escalation in 5 days. When markets start pricing the reality that the strait remains closed past day 5, gold reprices upward, silver reprices upward. The dollar comes under pressure from the inflation it is enabling. That is the historical pattern. Every time a major energy choke point has been disrupted for more than 60 days, it has not been different yet. Gold Western Spot is at approximately $4,300 to $4,388 following the session low of 4,099s. Silver Spot XAG USD is at approximately $67 to $74 following the COMEX May flash crash to $63.15. The Shanghai Gold Exchange and Shanghai Futures Exchange are closed today. When they reopen for Tuesday's session, the SGE to COMEX premium is the single most important data point available. In December 2025, SGE silver traded at $8 per ounce above COMEX. If that premium holds or widens despite today's paper crash, the physical market is telling you the paper market is the anomaly. The short-term picture is this. If the 10-year yield holds above 4.3% and the DXY holds above 99, gold faces continued pressure toward $4,000. If the 5-day Iran window produces a credible de-escalation signal and yields compress below 4.2%, gold reclaims $4,500 to $4,700 rapidly. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does tomorrow. Nobody can. The macro variables are moving faster than any technical setup can price. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. First, the U.S. 10-year yield at 4.41%, an 8-month high up 44 basis points since the war began, is the mechanical price suppressor for non-yielding gold and silver with no near-term reversal catalyst visible. Second, the DXY at 100, recovering from a February low of 96, raises the cost of gold for non-USD buyers, and historically correlates with commodity price pressure at this level. Third, the gold-to-silver ratio has exploded from 43 at January's peak back to 66 today, confirming that managed money deleveraging from record-long positions built during the January to February rally has not fully cleared. The bull case is equally real. First, gold at $4,099 to $4,300 is being suppressed by a mechanical macro event, not by a fundamental change in the de-dollarization trend, central bank accumulation, or the structural case for physical metals outside the paper system. Second, COMEX registered silver at 27.1 million ounces against 429 million ounces of paper open interest, with April 1st notice day 7 business days away, creates a live delivery pressure event that today's paper price crash does not resolve. Third, the 5-day Iran window is a binary event. Genuine de-escalation restores the Fed cut timeline, yields compress, the DXY weakens, and gold recovers toward $4,700 to $5,000 within 4 to 8 weeks. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Today rewrote the safe haven playbook. The question is not whether gold recovers. It is whether the yield environment allows it to recover before the April delivery window forces the paper physical reckoning in silver that the registered inventory data has been signaling for months. Don't take my word for it. Verify every number I gave you today. Check the data yourself. The Federal Reserve at federalreserve.gov, the U.S. Treasury yield curve at home.treasury.gov, the ICE DXY index data at theeast.com. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.